So, Terence, if you can project my presentation, I will proceed with the presentation. My presentation is the first of 3 today, and it is focusing on financing trade guarantees for fertilizer in Africa. If we can move on, Terence. The AVAP is a non-profit social enterprise which works with private sector agribusinesses along the agricultural inputs value chain in order to design and implement business solutions that positively impact on smallholder farm productivity. To emphasize, one, we are social enterprise. 2, we work with agribusinesses. Thirdly, we focus on the agricultural inputs, even though we are more on fertilizer. Agricultural inputs, that impact positively on a smallholder farmer productivity are the space where we specialize in. Our focus is in identifying innovative business solutions that can improve smallholder farm productivity. We have offices in 9 countries. In West Africa, we are in Ghana and Nigeria. In Eastern Africa, we are in Uganda, in Kenya, Tanzania, and in Southern Africa, we are in Malawi, Zambia, Mozambique, and South Africa itself. The other countries that are highlighted there are countries where we have had a project or another where we have provided support to agribusinesses or fertilizer companies seeking to enter markets in the regions that have been highlighted. Moving on, Terence. The approach that AVAP uses to deliver on its mission is basically to focus on 5 key pillars that underpin its approach to development. The first is agribusiness development services. These are services that focus on agribusinesses along the value chain to support or strengthen them in running their businesses, in establishing businesses, in growing their businesses. And in particular, we have worked very closely with the agro-dealers who are actually large wholesalers who have invested more than $700,000 in their businesses and are strong in the areas of network of retailers that they work with downstream. They are well linked to the upstream players. And again, they are invested in warehousing as well as tracking, and they can invest as well in market development support services like demand creation that we implement with them. The second pillar is market development services, and these are primarily to agribusinesses or large companies that are interested in African in entry into the African market or growth in expanding their businesses in the agricultural sector in Africa. And the range of services that are made available include short-term support services that may include market assessments, establishing distribution channels, as well as business growth in the countries where we operate. The third pillar is financial services. And in financial services, we have developed a model that has worked well in facilitating access to trade credit for the agro-dealers and small and medium-sized enterprises that we support, and link them to upstream players who can avail trade credit in order to expand the businesses, in order to address working capital challenges, and avail the product on time to smallholder farmers or downstream players. The third pillar is, or rather the fourth pillar is policy development services. These are essentially targeted on agro-input sector to improve the availability of agricultural inputs or improve the policy and regulatory frameworks in order to be able to advance availability of agricultural inputs in the ag sector across Africa. And the final pillar is market intelligence services, and these are services that draw a lot from the data and information that we have come to accumulate as we work at the downstream last mile area, where we have agro-dealers who are closely linked to the smaller farmers and to upstream suppliers, and have information on the products that move, the typology of farmers that are in a given area. And as a company seeks to enter a given market, we can generate information that is useful in establishing a presence in a target area. I've introduced AVAP and the way it delivers on its mission. I would like to move on to highlight an innovative fertilizer financing solution that we have implemented in the last 3 or 4 years across Africa, specifically Tanzania and Nigeria, but with much more intense work in Tanzania. Beginning from the top left corner of the slide, we have the large manufacturers, importers, exporters interested in availing or entering the African market. And essentially, as you may note, they may not be able to reach a smallholder farmer given the size of operation that they are engaged in. In between lies the agro-dealer as a key player in the value chain through whom agricultural inputs can be facilitated to reach the smaller farmers. AVAP works with over 500 such agro-dealers across Africa in different countries to provide support and strengthening those enterprises in order to be able to link effectively to the upstream importers and manufacturers who are availing of fertilizer, and especially in order to avail that downstream to the retail agro-dealers who are located closer to the farmers, and the product can reach the farmers. AVAP's key role here is to establish functional relationships between the key players or actors along the value chain. One of the very key and important relationships that we have found often wanting and has helped to build businesses that are able to address the aspect of trust between the key players. As a matter of fact, we have found that credit trade that we focus on can enable these agro-dealers grow their businesses tremendously, as they are able to move significant volumes of fertilizer at the right time once the relationship is functional. On the left bottom corner of this slide, you will find we have underwriters who are essentially development partners that we work with to underwrite or finance a credit guarantee facility that AVAP can use to de-risk the agro-dealers that we work with. And that de-risking encourages the upstream players to be able to work with the agro-dealers, and at the same time, it enables agro-dealers to increase the volume of fertilizer that they're able to handle. Essentially, the guarantee is usually 50% of what the upstream player, the supplier, advances in credit to the agro-dealer, so that in the event of default, AVAP will take care of 50% of what may be defaulted, while the supplier absorbs the other 50%. To minimize that risk further, we carry out risk profiling of the agro-dealers and work with the agro-dealers to develop risk mitigation plans so that they can be able to undertake the businesses that they are doing with less risk. And at the end of it all, the volumes of fertilizer that moves downstream increases significantly, as we shall see in our next slide. In the next slide, what I want to highlight, number one, is the fact that we implemented a program in Tanzania with funding from the Africa Fertilizer Financing Mechanism of the AFDB between 2019 and 2022. And it entailed a facility of 2 million euros, which enabled us to enter into arrangements with the key fertilizer companies in the company and guarantee a certain amount to each company. And the company also advances equivalent or guarantees itself for an equivalent amount. And that way we were able to facilitate significant volumes of fertilizers as we see in this slide. If we begin with the left-hand side of the slide, we see that with the guarantee facility from Africa Development Bank, a certain amount was guaranteed that AVA could advance or could assign guarantees further down to the suppliers, and the amount, as I've indicated, translated to 2.3 million US dollars. As I've indicated, the supplier also avails equivalent of the amount that is guaranteed as a credit to the agro-dealer that we work with. That immediately doubles the amount of fertilizer that is made available to the participating agro-dealers. The third stage is important for us to understand how it works. Most farmers buy their fertilizer at the onset of the rainfall, or at the onset of rainfall. That means that immediately the rain setting, there is a rush for farmers to access fertilizer. And we have seen cases where the agro-dealer shop is flooded with retailers and farmers buying fertilizer. Within a period of 1 month after the rain set, there is significant turnover of inventory of fertilizer as farmers buy and apply the fertilizer. And during that time, the agro-dealer need to be able to access replenishment of the inventory within the shortest time possible, so that it doesn't lose business. And the experience we had in Tanzania was that the number of tons during the year was 5 times the inventory that had been guaranteed, which increased the volume of fertilizer that was channeled through the scheme to 10 times the value of the guarantee. And the essence here is that this is credit that does not attract interest or bank interest. It is not subject to the bureaucratic demands that could take time as the paperwork is worked on, and it enables agro-dealers to access the credit in kind and in a more efficient way. The key is to establish trust between the players, that the upstream suppliers can avail the fertilizer as it is needed. And again, the the element of trust is advanced as agro-dealers demonstrate financial discipline, that they're able to pay on time. We monitor invoices to be sure that if an invoice is falling due, action is or rather it is followed up, so that timely payment encourages the confidence of upstream players to be able to extend credit to these agro-dealers. And we keep monitoring and dropping those that don't demonstrate financial discipline, and those that have the systems to demonstrate financial discipline are recommended to increase their credit ceiling, and in the process can be able to advance or access significant quantities of fertilizer. So that highlights the Tanzania case that we as AVAP are working towards replicating 6 other countries with funding that we are pursuing from different development partners, since as a model, it does promise to advance access to credit for the agro-dealers, SMEs that are key in moving this important farm input up to the farmer level. So at that point, I would like to shift back to Terence and introduce our next speaker. Comments and questions can be noted. We are going to be responding to them as we proceed. So at this point, I would like to invite Mary Claire, who has actually been our funding support at the bank, and we appreciate that. So Mary Claire, please take over. She heads the financing unit in the at the bank. Thank you.
Unmute. Okay. Okay. Good morning, good afternoon, everyone. My name is Marie Claire Karihangabo. I'm the coordinator of the Africa Fertilizer Financing Mechanism, which is a special fund administered by the African Development Bank. I've been the coordinator of the AFFM since November 2017, and I've been working in the fertilizer sector since the last 16 years. And AFFM was operational since 2018. And we've been implementing projects in some countries. So I can briefly introduce myself as such and my organization, and the rest will come into the presentation. Thank you.
Joseph, I think we would like to then ask the other speakers to also just give brief introductory remarks before we come back to Mary Claire for her presentation.
Thank you very much, Mr. Terence and Mr. Joseph, for organizing this event. My name's Hilary Dixon Pato. I work for OCP Africa in Tanzania. It's a great pleasure and honor to be part of this webinar this afternoon. Briefly, I will say some few words about OCP Africa. It's a subsidiary of OCP Group with headquarters in Casablanca in Morocco, established in 2016 with a special focus for Africa. This topic today comes at a very crucial point because fertilizer plays a very vital role in the agriculture, and it is taking a very big portion of the cost of production actually. And with an increased global population, and to be specific in Africa, the demand for food is increasing every year. That means that we need to produce more and more. And we as OCP Africa, we are at the center of this situation. We are the champion to ensure that almost all African countries are self-sufficient in terms of food security. So I'm very happy to be here on behalf of OCP Africa. I think we will share more experience at the later stage when the time comes. Thank you very much.
Hello, everybody. My name is Ayodele Balogun. I'm representing Wallace & Associates. I'm a consultant to Wallace & Associates. I've been in fertilizer for the past 10 years. Before then, I was in consumer goods, general management, manufacturing, marketing, operations, strategy. But over the last 10 years, a big part of my portfolio as a consultant has been working in fertilizer strategy, policy, techniques, finance for different organizations, public, donors, NGOs. But I also work with mid and small organizations, mostly in Nigeria, on growth. So SMEs who want to grow and have a capacity to grow, I support them. But I'm supporting Wallace & Associates at the moment with fertilizer finance work for the AU Summit and projects also for the AFDB, for Sustain, and for the Gates Foundation. Thank you.
Thank you, Ayo, and thank you, Hilary and Marie-Claire. I think we'll then move over to Marie-Claire's presentation. I will project it and we can begin.
Okay. Can you put in a full screen mode? Thank you. Thank you very much. Please, you can go back to, okay, thank you very much. As I mentioned earlier, AFFM is the Africa Fertilizer Financing Mechanism, and we have the privilege and honor to present to you the role of trade credit guarantees in improving fertilizer accessibility. And we know that trade credit guarantees are one of the financing models that are enabling access to finance, especially in the middle of the fertilizer value chain, specifically helping agro-dealers having access to finance and enable moving inputs downstream to the farm gate. Next, please. So briefly, I'm going to take you through the AFFM very briefly, and then we're going to talk about the trade credit guarantee structure, and then trade credit guarantees benefits for different stakeholders and users, and highlight some few successes, and then briefly talk about the requirement for successful trade credit guarantees. Next. So the Africa Fertilizer Financing Mechanism has been created long ago in 2006. But as I mentioned earlier, it became operational in 2018 with the mandate to assist African countries to increase agricultural productivity in the context of the CADAP program, the Agenda 23, and other development goals, such as Sustainable Development Goals. FFM has also the responsibility to attract or mobilize investments that would be needed to make fertilizer available and appropriately used by smallholder farmers. And for that, AFFM strives to provide innovative financing solutions that are required to make fertilizer use improve on the continent. Next. So AFFM works through three main strategic pillars. The first one being supporting access to finance, and the second being to the support the development of viable policies to improve trade, access, and appropriate use of fertilizer. And the third, to support farmers having access to input and technical assistance. So all our interventions are around these three main strategic pillars. Next. And FFM actually is using different financing instruments. Mainly, FFM focuses on credit guarantees and grants for technical assistance, but also FFM can use other financial solutions, which could be lines of credit or leverage private sector investment, can work through capital investment, capital markets, and work with different financial institutions to ensure that fertilizer sector has appropriate financing. And this can also be done by supporting or spreading innovative financing solutions that can enable proper access to finance for the value chain, the fertilizer value chain. Next. So now going into the topic for today, of course, we know that the financing needs for the fertilizer distribution to ensure that it reaches the farmers has increased or doubled during the last 2 years or 3 years, mainly due to the environment changes. Mainly because of the COVID-19 and the recent Russia invasion of Ukraine, so which has made financing quite a challenge in the sector. And now compounding the general scarcity of financing, especially from financial institutions, the trade credit guarantees as applied today. Joseph has presented one of the model. These actually are very useful and key in enabling access to financing along the distribution network and smoothing the movement of inputs up to the farm gate. And these trade credit guarantees are the risk-sharing facilities among different actors, as we will see in the next slide. Next, please. Well, I wanted to present some structures. I'm not going to spend more time on this one because it's similar to what Joseph has presented. And this is the actual model that we've been implementing with AFAP in Tanzania and Nigeria, and that we plan to implement in other countries, notably in Mozambique, Uganda, and again, reduplicate in scale up in Tanzania. And as you can see here, this trade credit guarantee can enable easy access to input to farmers through the supplier, hub agro-dealer, and retail agro-dealers, as detailed by Joseph previously. Next. So this is another kind of model that we are working with suppliers directly. And as you can see, we are implementing this model with OCP in Ghana and Cote d'Ivoire, where we do share the risk at pari passu 50%. We share the risk at 50%. And we have partners that OCP avail inputs to aggregators and farmers cooperatives. Not only fertilizer, but also OCP enables access to seeds and other crop protection products to the farmers, and the farmers will pay on upfront deposit of 20% only, and they will reimburse the input received on credit at harvest. So, and this model also enables access to food crop markets because it includes aggregators who will not only distribute inputs to farmers, but also collect the food crops at harvest. And after collecting the products, they will pay back the input received on credit, and they give the balance to the farmers. Through this program also, we do have capacity building, technical assistance. Farmers are supported pre-season, during the season, and post-season to ensure that they apply the best agricultural practices, and they're able to get the targeted increase in yield. So basically, this model is being implemented in Ghana and Cote d'Ivoire, and we hope to also scale it up to other countries, as it enables farmers also have access to input on credit. Next. So now I'm going to talk a bit about the benefits for the trade credit guarantees for different stakeholders involved. And here, starting by AFFM that provides the trade credit guarantees. As we work with different implementing partners, you have heard that we've been working with FAP. For AFFM or FAP, who would bid or any other underwriter, this enabled to do more with less, actually, because as I mentioned earlier, this trade credit guarantee model attracts private sector investment because we do actually share the risk with them on an agreed upon percentage. We've been talking about 50%, but it's possible also to agree or negotiate the risk that can be shared with the supplier at a different percentage. It also enables to preserve cash. This guarantee is unfunded, which means that the cash remains with the underwriter, in this case, AFFM. And this fund can be used and called upon only if there is a default. Again, on AFFM side, it is actually the efficient use of existing pool of funds. Though AFFM was initially supposed to be the channel through which all financing for the Abuja Declaration will be, that was not the case, and which means that today AFFM doesn't have the required funding to support fertilizer sector in general, even not enough to support the input distribution. So it's efficient way to use the guarantees that where we share the risk with other partners and be able to reach more results. And as explained, Joseph, this is actually a revolving fund. It can be used on several seasons, and can be leveraged several times, as long as the default has been very minimal. So it is an efficient way of actually supporting input distribution to the farmer and by enabling access to financing to agro-dealers. Next. For the supplier, it is also a good instrument because it's an affordable financing. We initially started making this trade credit guarantee free of charge with the previous projects, but also it can be negotiated with very minimal guarantee fee compared to the lending fees that can be imposed when the financial institutions are involved. But also for the supplier, this will help to mitigate default risk from agro-dealer and farmers depending on which type of model. It also enables the supplier to have hands-on the risk on management of credit risk and monitoring the instruments for the efficacy of the guarantee. Actually, because the supplier continue working through its own structure with own tools to monitor the guarantee. So also it enable the supplier actually to control the movement of inputs from supplier to agro-dealer and enables them to know how the inputs get to the end user. So it can also increase businesses because as the FFM or any underwriter is sharing the risk with the supplier, this enables the supplier to increase the amount of input provided on credit to actually to the supply, to agro-dealers, and then downstream to the farmers. Next. So the credit guarantee is most beneficial to the agro-dealers and the farmers because it enables quick, actually, and easy access to finance for agro-dealers or other input distributors and farmers, because definitely there is no other third parties involved, as these trade credit guarantees is between the underwriter, implementing partner, or with the supplier and the agro-dealer. So and the decision to provide inputs on credit depends on the suppliers who can use its own pool of agro-dealers or even onboard new ones as based on their own selection criteria. They also save on deposit. If they are able to have access to input on credit, they can use their deposit for some other needs in their businesses, and it increases their turnover because supplier, knowing that he shares the risk, can provide more volumes to the agro-dealer based on the fact that actually the suppliers have now more trust in the distribution systems and have shared the risk, and this would help agro-dealers to create more linkages and more relationship and trust between the partners. These models has also proved to reduce farmers' upfront deposit, as I mentioned. With OCP in Ghana and Cote d'Ivoire, farmers can pay upfront deposit between 40% and 20%, and the current project is only 20%. In addition to that, as I mentioned earlier, this model with OCP increases knowledge for farmers, but also have agro-dealers get capacity building different topics, such as with business management, good agricultural practices, etc. It connects also farmers to food markets, as I mentioned earlier with the OCP model. Next. So here I wanted to show some results we got from some projects with FAP in Tanzania. Joseph talked about it. As you can see, as you have seen, and you can see here actually, with €2 million guarantee over a period, main season between 2019 and 2022. The fertilizer valued at €26 million were sold based on that €2 million euro guarantee. And this is an average of 13 times over that period. And as we can see, we worked with different agro-dealers, 26, who also got access to capacity building, and we worked with 3 suppliers. And 966 retail agro-dealers were involved, and 570,000 farmers had access to input through this credit guarantee model. So as you can see, the leverage is quite important. And you will see that also we have put a small grant to enable capacity building into this Tanzania project with FAP. And for OCP, 76 aggregators and field officers were trained in business skills, facilitation skills, farming, good agricultural practices, etc. And 13,000 farmers were trained in good agricultural practices. In addition to that, 11,000 farmers had access to fertilizer on credit with 20% upfront deposit. So this is to highlight how these models can actually enable access to inputs, not only fertilizer, but also other inputs. Next. So this trade credit guarantee model, to be successful, first, there is a need for capital. Working capital on the seller level, which means the supplier has to be, first, the supplier has to be willing to share the risk. They have to be incentivized to do that, but also have capital to lock into these sales that are provided into the guarantees. With back experience, we've noticed that supplier can provide a credit on a very short term, 30 days, 60 days, 90 days. And this is what can also enable a revolving fund. But in the other models also, as I mentioned, you notice that with OCP, it has to be at the end of the cropping season to enable reusing the guarantee, which makes actually the revolving much lower, but with more impact because it concerns helping farmers having access to input on credit. In addition to that, the guarantee fund has also to be increased. Because as FFM, we've been providing credit guarantees for 2 million per country. If we take a country, even Tanzania, it's a drop. More fund would be required actually to have a guarantee fund that can make a very visible impact. In addition to that, there is a need to have the capacity for implementation. For both on the side of an implementing partner or on the side of supplier. And the recommendation here is just to first build the capacity, but also put in place tools probably if better the digital tools that can track the movement of input from the supplier to the farmer and be able to monitor the payment and the default, which is really important to make sure that we are able to record the proper results, but also get appropriate and expected impact from the project. And lastly, this link of trust between the supplier and agro-dealer has to be enforced. This model is one that actually enabled this trust between the actors all along the value chain. But also it's really important as in case there are other actors like retail agro-dealer to ensure that there is no gap or the chain is discontinued. The access to financing should be available at all levels. In case we have, for example, retail agro-dealers, they should also be enabled access to finance so as we ensure that farmers also have access to inputs without delay. Thank you. Next, I think this is the end of the presentation. And we thank you, we thank EFAP for this opportunity, and we continue our partnerships, and we may remain available for any, we're ready to answer any questions. Thank you. Over.
Over to you, Joseph, for you to introduce the next speaker. I think we're going to have Hilary come up next.
Thank you very much, Mr. Teres. You can project my slides. Yeah, so on my side, I was given a topic to discuss about the industry perspective on the trade credit guarantee. And I will dwell also my experience with what we did with AFFM and AFAP in Tanzania. We can move to the second slide. So I started by trying to introduce and explain like what does really trade credit guarantee entails. These are crucial financial instruments that gives security and somehow mitigate the risk which are associated with the trade. And now to be specific on the fertilizer trade. It's a tool that obviously protects mainly the supplier against potential losses that resulting from the buyer's default. And here in Tanzania, we have quite some very good experiences on how the default rates have been in the fertilizer business. Most of the companies have really run into losses when they start to act as banks, trying to push to distribute fertilizers to the last mile through the distributors. And because most of the distributors, they're not well screened, they don't have very good business ethics, many companies have ending up making sales, but completely failed to recover from what they've managed to do. So at the supplier, it protects us, for example, I will speak on OCP context, against the risk of non-payments, and it reduces the financial losses that might happen. But also it improves the cash flow management and stability, because with the trade guarantee that we had done with AFFM, supervised by AFAP, we managed to really turn around our business in quite a number of folds. You will see it in the other slides. But also it enhanced the confidence in extending credit to buyers. So as I say, it's a shared risk project. Each part has to give in a portion of risk. And it has helped us a lot to build the confidence in dealing with these agro-dealers. But also it gives us an opportunity to extend our customer base and increase our sales. For example, now we are starting to target regions with high potential for agriculture, but very minimum reach in terms of product availability. So when AFAP coming in with this program under AFDB, the financing mechanism, it gave us the confidence to expand our reach and go to places and deal with distributors that we have never been dealing with them before. But on the side of the buyers, and to be specific with these agro-dealers, it gave them the opportunity to access goods and services, and to be specific now, fertilizers on credit, and help them to facilitate their business, because some of them, they are sitting in areas with huge potential for agriculture. They're demanding for agro input and fertilizer, which is taking a very big part of it, is huge, but their capital is quite low. So this kind of trade credit guarantee, it gave these agro-dealers access to credit that will help them to expand their business. But also it enhanced the credibility and trustworthiness with the suppliers. So when we know that this customer we are working with is partly covered by the AFFM program, for them as agro-dealer is an advantage, because we give them more priority than working with clients who want to work with us directly on a credit basis. And eventually it improved the purchasing powers and the negotiation leverage, when they have ability to draw more from our side, given the fact that they have a facility with AFFM. They have a very big room to negotiate in terms of pricing, in terms of delivery, and hence eventually the whole fertilizer value chain is improved. You can move to the other slide. So as OCP Africa, we have our shared ambition, which is to unlock the full potential of Africa food system by accelerating the transformative investment in agriculture value chain. And we are doing it through 4 main pillars. First, contribute to global food security. How we do it? By developing high yield and resilient production systems. We also enhance value addition captured. So across Africa value chain, especially to smallholder farmers, but also to strengthen African food sovereignty by growing the diverse and nutritious crop to substitute import and enrich exports. And lastly, to establish sustainable Africa food system that are the natively resilient and low emission. We can move to the other slide. So today, the need for fertilizer trade credit guarantee schemes in Africa, I would say, is much more higher than ever before. The population in Africa is increasing. Countries need more and more trade credit financing so that they can be able to meet the demand to produce food as a means of food sufficient and for export. And when I spoke of countries, this trade credit guarantees can be at 2 different levels. Many countries in Africa, they don't produce their own fertilizers. We import. So if you want to import fertilizers, you need to have some trade covers. That's an area that I will wish AFDB also through the AFFM, I wish to look at one step back before we meet the agro-dealer. How do we ensure the countries are self-sufficient in terms of fertilizer availability? Today, I would say most of the East African countries, they are faced a lot with the issue of access to hard currency. This by itself is posing a very big risk in terms of assurance that if these countries will be able to import for the next coming season, the cropping season. So for me, I find this also as an area also to AFDB through the AFFM projects and AFAP. How can we work now with the importers to ensure that they are able to also import the fertilizer in countries timely? As I say, very few countries in Africa, they produce fertilizer. That means that for you to import, you need hard currency. So maybe there can be different trade guarantee schemes at different levels that we can do. But also, different countries have different, I would say, cultures in terms of tradition and how they operate. So maybe also these trade credit schemes should be country specifics, so that even they become more sustainable to run them. So also, there is a need to look on financing of domestic production of customized fertilizer blends. So we understand that, as I say, many countries import fertilizers. Maybe there is the need also to improve on this area to empower countries to be able to produce blended fertilizers within the country. OCP Africa today, we have a domestic production capacity of over 1.2 million tons of fertilizers in different countries specific. There is a special slide on that. But the trade credit guarantees also assure timely importation of fertilizers, because farming goes with seasonality. And when farming has to rely a lot with the rainfall, it is very important that first, the companies who are importers or governments are able to import the fertilizer on time, so that even those agro-dealers will have access to these fertilizers on time. But also, with access to trade credit guarantees, it boosts trading capacities to domestic distribution channel. And a good example is this very successful AFFM program that was implemented in Tanzania over the last 3 years. And we as OCP Tanzania played a very big role into this. We can go to the other slide. So as explained earlier, today OCP Africa has a production capacity of 1.2 million tons across Africa, with blenders in operation in Rwanda with around 100,000 metric ton per annum, Nigeria with over 500,000 production capacity, Cote d'Ivoire with 120 production capacity per annum, Ethiopia with around 200,000 metric ton production per annum, Senegal also with 150. And today, OCP Africa is looking to expand next year into Ghana, Tanzania, where we are, and most likely also in Kenya. And by 2027, OCP Africa is looking to be in Angola, expanding the capacity in Ethiopia and Cote d'Ivoire and other markets in Africa. We can go to the next slide. So now I'll try to deeper dive on the trade credit guarantee to agro-dealer that we as OCP Tanzania were a part of it over the last 2 to 3 years. As it's been stated by Marie, the distributors and agro-dealers, they need short-term credit facility and credit guarantee for them to be able to deal with the farmers, supply farmers with the product on time. Although the practice in many African countries, and I can cite in Tanzania, the farmers, they don't take products on credit, but for the farmers to have access to those fertilizers, someone has to put them to the closest point possible. That's where the agro-dealer is coming. So most of them, they might have the capacity to source from the supplier, but the capacity, you cannot compare to the actual demand that they are saving. And through the AFFM credit guarantee that was implemented between 2020 and 2021, we were given a portion of around 950,000 euros as OCP Tanzania, as a portion, as a cover to rotate, working with 12 distributors that were well selected through the process with the help of FAP Tanzania. So in 1 year by itself, these 12 companies, these agro-dealers, they roll more than 8 times of the value of the cash cover that we are given as OCP Tanzania. To me, this was something which was well, surprising, but it tells me that if we source and work with the right agro-dealers, and if you have the right product on time, with the increasing demand for food and willingness by farmers to produce, there is a very big chance also even to increase the nutrients uptake per hectare that today we are lagging behind as many of African countries. So this was one of the best, I would say, success stories that we have had dealing with agro-dealers on credit. With the confidence that we got from the AFFM project, we managed to do quite an amazing piece of work. And I saw most of these agro-dealers were recognized in different platforms for this huge effort that they managed to pull up. And we as OCP Tanzania, we will continue to work very closely with AFAP to make sure that should there be an opportunity to roll, and I know that also it is in the process to relaunch the AFFM for the coming season, we are really willing and able to scale up this operation. You go to the next slide. So just to show you the key figures, these 12 agro-dealers, they really managed to do quite an amazing work. We were allocated, as I say, 950,000 euros, but we managed to do transaction worth almost 22 billion Tanzanian shillings. So thank you very much, AFDB, through this AFFM project, but also a very big round of applause for AFAP for really successfully implementing this program. Can you go to the next slide? Yeah, I think everything has its own challenges. I will say today, trade credit for guarantee, especially on agriculture, it is not that easily accessible by many players. You have very few of interest-free, collateral-free facility that you can get, like the one from AFFM. There is a situation in the market that you have to go with what the market is offering. And mainly it's coming from the banks, which are commercial banks. And the interest rates are very high. I will say in countries where fertilizer market is regulated, like Tanzania, commercial agriculture loans are not that much attractive to many of the traders because they are not able to recover the cost of finance given the fertilizer indicative prices that are given by the government. But among other, also there's very limited awareness and understanding of trade credit guarantees among business. So most of these traders also, they are not people who have really big financial knowledge. So we need to invest a lot on training them and sharing them what are the opportunities available that they can explore. But again, as I said, the capacity constraints, most of the banks, they have the limited budgeted window for financing agriculture. And sometimes when they are financing agriculture, maybe they are financing the crop, not the inputs. And the crop side maybe is the one that has relatively low interest rate. But when you're going to finance inputs, the rates are mainly the market rates. I know the Ministry of Agriculture has been pushing a lot to have interest rates as low as 10%. It has started to be implemented by some of the big banks, but still it's quite a journey. But also there are potential risks that are related to fraud and misuse of credit facility. Still, even if you are doing some screening on these agro-dealers, sometimes they misbehave. So you still have some risk of some of them not working in line with the terms and guidelines of the agreement. And some of the mitigation strategies is to continue to give educational programs and workshops to raise awareness and to promote understanding, to do some capacity building initiative for trade credit guarantee institutions, and the implementation of the robust risk assessment and monitoring mechanism. So just to finalize, I would like to say that the trade credit guarantee plays a vital role in promoting financial security and facilitating fertilizer trade in Africa, both import and export level, and through the fertilizer distribution value chain. By leveraging these instruments, Africa can enhance access to fertilizer inputs. It can mitigate credit risk, it can foster trust, and enhance the competitiveness in the market. So it is very important for stakeholders to be aware of the benefits and mechanisms associated with the trade credit guarantees to make informed decisions and maximize their advantages. Thank you very much. You can go to the last slide, Teres. Thank you, Joseph.
Thank you, Hilary. That is very comprehensive. Apologies for the earlier itch. I was muted and could not unmute. Do we have Ayo in? Ayo, it is your turn. And let me point out that we are still receiving a few questions and comments on the chat. Please put them down. We have 20 minutes to, or 17 minutes to finish. Ayo, it is your turn, and then we will take questions. Thank you.
Thank you, Joseph. So I'm talking about access to finance for fertilizer investments in Africa. But I'd like to set the stage and talk a bit about, I know we talk a lot about access, but finance normally has an objective. So generally, the objective of finance is to create value. So what finance will be seeking to support is an operation that's creating value. If we look at fertilizers, there's a broader goal, I imagine, of agricultural production, or if we like, agricultural productivity. We know we can achieve production without productivity. That's what sub-Saharan Africa has been doing for a while by expanding land. But that's okay too. At least there's more production. But productivity has always been the objective of agriculture, which we imagine is the more sustainable path to take. So effectively, finance, normally to be creating value sustainably, needs to be supporting actions or activities that increase production or increase productivity. Now, in the sector, in the fertilizer sector, there are two sorts of clients according to the experience that we have when we look at the different markets. There is a client that is government, there's a client that is farmer. And the business model of the actor, the business model of the actor in fertilizer who's seeking finance is different depending on which client the actor is supporting. So effectively, when the actor is seeking to gain value from governments, then it means that the type of financing the actor will be seeking is generally opportunistic finance, because government funding and government activities are generally not very sustainable. Government is there to trigger something, to intervene, and to leave. So if government is the client, then the financing that the actor is seeking is generally opportunistic and sometimes even predatory. The impression we have for this webinar is to talk about the more sustainable financing structure. And the more sustainable financing structure is the actor that is actually seeking to create value that ultimately the farmer benefits from. So that's the assumption under which that I'm making the presentation. So I'm following the real value creation chain rather than the which seeks to add value to the farmer, rather than the government as a client actor. Terence, please. Next slide. So I won't take you through the fertilizer supply chain because you are aware of the chain. I mean, from the domestic manufacturer all the way to the smallholder farmer. But we know that from an access perspective, the large manufacturers and big producers know how to gain access. They have relationships, they have competencies, they can get finance. They don't have a problem getting finance. So we're not going to be dealing with them. We're going to be dealing for the farmer also at the other end. It's a complicated situation. Farmer financing, we'll talk a little bit about it. But OCP and Marie-Claire of AFFM have talked a bit about farmer financing with a program where they reach the farmer directly and finance the farmer through a system of where they link the farmer to a processor, an anchor, I'd say an anchor, and the farmer is provided not just with financing, but with technical assistance too. So I'm going to talk mainly about the middle of the chain. I mean, so the middle of the chain between the large manufacturer and the farmer. So mostly talking about the distributors, the agro-dealers in the chain. Next, please, Terence. So some fundamentals that we know. I mean, that transactions across the supply chain normally vary according to size of the transaction, according to the frequency of the transaction, so effectively movements, and according to the credit characteristics of each participant. So whether it's a beneficiary of finance or a supplier of finance, they have different characteristics. And all of these elements make for a complex situation. So they make for a complex situation within which finance has to be delivered. Now, as you move up the chain, it's relatively easier because the transactions are significantly larger and happen over a longer period of time. So it's significantly easier. But as you go further down the chain, the transactions reduce as you go down the chain. So they're much smaller. And the frequency of occurrence of the transactions changes significantly. So effectively, the complexity increases from a finance perspective. Next, please, Terence. And so effectively, if we want to break it down, and I won't sort of bore you, I mean, the presentation will be made available, so we can look at the very different details of the financing attributes of each part of the chain. But as you move away from the producer, from a producer perspective, especially the importer and the really large manufacturer, bringing products into the country is probably the most effective financing a country will have and the sector will have, because they get the financing cheaply, relatively. They get financing cheaply. They have the balance sheet to get it cheaply. And you, on the base of the financing costs, which are lower than any other person can receive, they bring the products in. And if they bring the products in, they create a situation where it's possible to distribute the products by introducing other elements that can make the product distribution effective. And when I say other elements, I mean financing elements. When you move to the next level, for the agro-dealer to buy from an importer, there are different things that could happen. The agro-dealer could have sufficient liquidity, in which case the agro-dealer doesn't have any needs for working capital finance, doesn't have any needs for liquidity, and is able to buy and distributes. But we find that to be very rare in the countries that we deal with. What we find is that buyers generally have limited working capital as you get into the distribution area. And they have also limited equity. So effectively, when they have limited equity, it means they have limited collateral. It means their access to working capital from typical financial institutions like commercial banks is limited. So they have limited access because they have limited equity. Now, they could benefit from trade credit sales because the manufacturers have brought products in. So they could benefit from trade credit sales, but it depends on whether they are trustworthy. If they're trustworthy, then they could benefit from it. And when I say if they're trustworthy, if the importer or the large manufacturer considers them trustworthy. So there's a perception of trust that's important also in the financing structure. Now, that's exactly the same problem the wholesaler or the hub agro dealer, it's the same problem the hub agro dealer has. That's the retailer that's just below the hub agro dealer has. So between the two of them, they have exactly the same problems of sometimes limited working capital, limited equity, and an issue of trust. So effectively, how does one structure credits to that sector with those problems is the big financing issue in the fertilizer sector. And a part of it, Marie-Claire and Hilary have spoken to. Then after, if we move to the farmer, who's the sort of the difficult part, generally what we find in the sector is that actually the farmer generally, there's two types of demand at the farmer level. There's what we call efficient demand. So there's a farming population that has money to pay for the fertilizers, can afford to pay for it, is willing to pay for it, but sometimes cannot get it. But having the money, be willing to pay for it, and wanting it is what we call efficient demand. And we find that sometimes the efficient demand is not satisfied because the fertilizer doesn't get to the farmer because there are all sorts of reasons that the flow is constrained upstream of the farmer. And so effectively, there's a willing farmer who wants to buy, but the product doesn't get to the willing farmer for all sorts of reasons. But then we also have latent demand. Latent demand is that the farmer has the capacity to buy. He doesn't know about fertilizers enough. It's possible. He doesn't have the money. That's possible also. But he has the assets, which is the land, that he could sweat if he had fertilizer and the technologies associated with fertilizer and financing to help him use the fertilizer. Now, latent demand, getting to latent demand demands a lot more work. But first, it's important that a lot of the distribution problems be resolved to at least meet effective demand of the farmer. So effectively, the constraints in the products flowing to the farmer to meet effective demand, it's important that those constraints be highlighted, and finance is an implicit part of that. Because of the elements that I mentioned, elements of working capital, of collateral, equity, and of trust. Next, please. Terence. Terence? So, yes, so I summarized those here that, I mean, so what the fertilizer distribution chain suffers from fundamentally is a lack of equity, a lack of working capital, and a lack of risk-bearing capacity. That's trust, lack of trust. And solving those problems, we have found traditional financing institutions and financing structures don't work. They are constrained from solving those problems. And it's because they're constrained is why new innovative structures like the AFFM mechanism was set up. It's why innovative structures continue to be developed by the private sector, like OCP, to try to get beyond those problems, because the traditional financing institutions don't work. So effectively, banks, commercial banks, are not going to help solve the problem. Other monies might be available to do that, but we'll talk about that later in terms of implementation. Next, Terence. Terence? So trade credits is absolutely important with respect to solving those problems. And importance of trade credits, I mean, to the solution basically is to provide some guarantees, and sometimes working capital is required. But the two, I mean, guarantees and working capital they could take on a complexity of possibilities depending on what the problem is. So what we've done here is to make a list of the different potential issues affecting fertilizer transactions and what tool might be necessary, or a combination of tools might be necessary to solve that problem. So for example, if it's limited working capital that a credit provider has, so for example, if it's a hub agro dealer that does not have working capital, a hub agro dealer that does not have working capital, it's difficult for the hub agro dealer to accept a guarantee for a retailer that's attached to the hub agro dealer, because there isn't enough working capital to create the stock for the retailer, whether it's a partial guarantee or a full guarantee. What the hub agro dealer actually liquidity, it's working capital. If there's an issue of a very low equity base for a credit recipient, then guarantees would work. And guarantees would work naturally when the credit recipient has been analyzed and shown to exhibit enough of a professionalism to assure the guarantor that the recipient is trustworthy. So it could be a partial, it could be a full guarantee, but the guarantee is essential. And in that case, with a low equity base, liquidity doesn't work because there isn't enough of an equity base to absorb the liquidity. So I've given two examples. I don't think it's necessary to continue to run down the list. Like I said, the presentation will be made available, but that's how it works. I mean, so exactly what does the recipient want? Exactly what does the supplier have? And how does one marry the two? And in there, guarantees and working capital can be used to create significant value in the distribution chain. Now, for those to work, if we're saying traditional institutions don't know how to do it, or are unwilling to do it, or are constrained from doing it, it means other people have to do them. And the two parts to the work other people have to develop. One is to raise the money to look at these problems. The other is, after raising the money, to get the money to work. And getting the money to work means implementation capacity. It means having organizations on the ground who can implement. Next, please, Terence.
Our time is running up.
Yeah, we've got two more slides, Joseph.
Went down. Thank you.
Yeah. So it means, so this slide gives examples of organizations that can implement and organizations that tend to have money or have raised money. So the organizations clustered to the left are the organizations that we call implementation capable. So they're the commercial banks. They've got feet on the ground. Informal money lenders, microfinance entities, they've got feet on the ground, but they operate in a particular way that they're not able to solve those problems. These other not implementation capable are able to think about solutions and raise money, but they do not have feet on the ground and they need to work with partners to implement. And that's why it's important. And so, for example, you've got the AFFM that has raised some money and hopefully will raise a lot more money. The AFFM needs organizations like IFA to implement after having taken decisions regarding which financial products to offer which participants in the supply chain. The FFM then needs IFA to help with the decision-making, but also help with implementation. Next, Terence. Terence? Yes, so we've made a list also of some, it's not exclusive, of some programs that have been different with respect to financing of the supply chain that have been what we'll call slightly non-traditional with respect to the supply chain. So programs like that are anchor-driven, programs that offer guarantees, and all sorts of other programs that are absolutely linked to solving those problems that the middle of the supply chain has. So if I recap, I mean, the recipients, of course, needs to be creating value. So effectively, the recipients of the financing needs to have a business model that is sustainable, effectively, that's looking at creating value ultimately to the farmer. Government distortions, government activities, government as a client doesn't work, and we're not treating that. Within the supply chain, for anything to happen, there must be trust. Without the trust, there cannot be credits. There can't be trade credits without trust, especially since the middle of the supply chain lacks working capital, sufficient working capital equity. So trust is absolutely essential. Trust is the element, really, the fundamental element to now build on. And lastly, even if one has a solution for all of those, one will need an implementation agency that financially savvy to help to put all of those together. Thank you.
Thank you, Ayo. We are at the top of the hour, and we are past by 4 minutes. But I want to thank you to thank the presenters for very detailed presentations. We have heard it from the consultant himself in terms of assessing and evaluating the workings of trade credit guarantee facilitation. We have heard it from the development partner, AFFM, and the different models that are in use. You have heard it from the private sector itself through OCP and the utility and importance of the trade credit guarantee provisioning that has been ongoing. And earlier on, we heard it from EVAP itself, and its experiences in the implementation of the trade credit guarantee provisioning. You've got one question that I would have liked to address before. Actually, there are two that I would like to address before we close. And I will direct this question to Ayo, if you can prepare as I respond to the other one before we close the session. And the question is from Ben Valk. And the question is, how should we look at economic viability and scalability of trade guarantee facility, given the absence of interest rates or interest charges or guarantee fees? As you prepare on that question, Ayo, I would like to respond to an earlier question that Terence did respond to, and that's about our presence in Zimbabwe. We don't yet have a presence in Zimbabwe yet, but are looking at a number of countries where we could have presence. Normally, the way we establish a program is when we seek and get funding, funded project in a country, and we use that as an entry point. For now, we don't have a presence in Zimbabwe. Ayo, would you like to comment on that question from Ben?
Yeah, I could, and I would, and I will, and I think it's difficult to guarantee any scalability when one is not charging for the guarantee facility. I mean, the guarantee facility, like every other financial instrument, is supposed to be used to create value, and the value that it creates normally should be able to support that facility. I mean, so effectively, the facility should be sustainable. And sustainability means that it creates enough value for it to be able to extract some from the value to support itself. So I can imagine a 0% interest or guarantee fee being the start, what I'd call the pilots of a facility or of that nature. But as soon as the structure shows proof of success, it needs to be changed for it to be scaled up. It can't be relying strictly on. I mean, I don't know what's going to help it to be sustainable without actually getting fees from the value it creates, and that also drives it to continuously try to create value, so that it can continue to sort of support itself. So yes, I mean, to Ben, I don't see sustainability when it can't charge a fee.
Thank you, Ayo. Just to add to what I was saying, new guarantee facilities that AVAP is implementing will be attracting a guarantee fees, and that has become policy. So, and I do remember that Mary Claire did indicate that the size of that guarantee fees is to be negotiated and discussed with the development partners and the parties involved. I have to apologize that we have gone beyond time. We have a few questions that are still coming through. What I would suggest is that we write back to the participants to respond to a few of the questions that have come through. For example, what are the key performance indicators that is straightforward to do? Actually, that's the main one, which I would say is that the key indicators, as earlier on indicated, one is leverage, the amount of fertilizer that is created, additional fertilizer sales that arise as a result of facilitating a trade period guarantee facilitation. Impact can be traced back to the farmer level, use of fertilizer leading to increases in productivity, the number of farmers reached, the volume of fertilizer that is sold, as well as the value of that fertilizer. Those are some of the key performance indicators that we have used. I think I will bring this session to an end with much and a lot of appreciation to all the participants and the presenters. Thank you very much. Let's hope to see you in the next session of our webinar series. Thank you for now.
Thank you, Joseph.
Thank you very much.
Thank you.